Alrighty, everybody, welcome to another episode of Systematic Investing. Just before I get going, this is just obviously, as you see down there in the bottom, this is not financial advice. This is educational and entertainment purposes only. I'm not a financial advisor, and this is not investment advice. Do your own research, please. I'm just some guy on the internet. And yeah, all right, let's get into it. So today, we're going to be talking about my biggest holding in my portfolio, and that is going to be Palantir. Palantir. Gotta add this picture in. For anybody who doesn't know, Palantir is an item in Lord of the Rings. It's that little orb right there. You ever seen the movie? Read the books? Get on it because banger. That's all I gotta say. But realistically, today we're gonna be talking about is Palantir has it entered bubble territory? As everybody knows, it's gone from $6 to $150 in the last about 2 years. So, I mean, with a 25x run up, there's always the risk of having overrun their valuation and really gotten, you know, they're trading at over 100 times sales. So let's find out, is it worth it or not? So first off, we're just going to go over Palantir's business, see what kind of numbers they've been doing, see what kind of trajectory they're on, and then we'll go from there. So first off, just what they do, they engage in providing enterprise software to large-scale clients. Their software essentially links all companies' data into a single platform in order to provide predictive insights and augment efficiency within the enterprise on all levels. So they provide a super powerful system to ensure that everyone in a company is armed with the data and insights required to help them do their job. Their AI tools help to automate as much as possible without actually replacing the workers. The goal for them is to get as best possible productivity gains from each worker. So as opposed to a lot of things you see with AI, they'll be like, oh, AI is going to replace the workers. Palantir kind of takes a different approach and they augment the workers. So they, like I just mentioned, they arm each person with data they need and and only the data they need that's already picked apart and curated so that you don't have to be like, oh, what does this mean? What does this mean? Go through it. It's already picked apart, ready to go for you. Keep you moving as fast as you possibly can. So they have different units of their business. So they have their government and commercial business. Government is still 55% of revenue and commercial is 45% of revenue. Government overall does have higher growth still at 45% revenue growth versus 33 for commercial. But I must say they have a very large international business, and the international commercial business, for whatever reason, kind of sucks. But so yeah, Palantir is very large international as well as U.S. business for both commercial and government. The U.S. portion of the business grows at a much higher clip on both the government and commercial side due to AI being adopted much more quickly in the United States. Although it seems the government is faster growing sector, let's take a look at U.S. commercial specifically. So, I mean, U.S. commercial, as you see, is cooking. So you saw, go back here, 33% revenue growth overall versus 71 for the United States. So you can just gauge based on that the international commercial business kind of sucks. And it's hard to say why, but I mean, you can see U.S. Commercial sector is booming. It's due to U.S. corporations obviously piling into AI investment, and Palantir is the best and brightest on the block in the enterprise AI sector. They're one of a kind in the sense that they have a working AI ready to go out of the box, custom tailored to your enterprise. Alex Karp and company have stated many times last year that the phone is ringing off the hook with large enterprises coming after the new AIP product, which is artificial intelligence platform. A lot of people have been saying artificial intelligence platform is going to be the building block of large enterprises going forward. So obviously it's a huge opportunity for them. But I mean, still, we're only at about 255 million U.S. commercial revenue a quarter, which is annualized about a billion. So I mean, they have a long way to go before becoming the absolute king of AI in a $500 stock slash trillion-dollar company. So balance sheet, this is one of my favorite things. I mean, this is just downright gorgeous. You have 5.4 billion in cash equivalents, in U.S. Treasury securities, and treat it zero debt. So they have an insane opportunity fund to kind of do whatever they want, whatever they need. And then over here you have cash from operations and adjusted free cash flow, and you got 35% margin versus 20 last year for cash from operations, and adjusted free cash flow 42% versus 23% last year. Obviously, those are cash from operations is not adjusted, but adjusted free cash flow. Kind of nitpicking some numbers here and there, but that's still really good. I mean, yeah, that's you gotta love it. They're running high margins, high growth, insane balance sheet. So when you love to see it. So here we're gonna keep looking at some different things here. So U.S. commercial continues to accelerate in Q1 2025 along AIP revolutions. You saw earlier 71% year over year U.S. commercial growth, 19% quarter over quarter U.S. commercial revenue growth, and then the customer count up 65%, and the commercial customer count up 13% quarter over quarter. The remaining deal value up 127%, and U.S. commercial remaining deal value up 30% quarter over quarter. 2 times year over year commercial deals closed of 1 million or greater, and U.S. commercial total contract value of 810 million, which is up 183% year over year. So huge numbers in the U.S. commercial sector. It almost looks like they're kind of accelerating at a faster than 71% growth due to the 19% year over year, or sorry, not year over year, quarter over quarter growth, and the 30% quarter over quarter remaining deal value. But that could just be due to long-term deals. It's kind of hard to say. I mean, they have a kind of a complex business in how they, get their different revenues realized and all that. But down here in the bottom left, we got Q1 2025 adjusted operating income of 391 million with a 44% margin. So that's huge. I mean, 44% margin. Obviously, it's adjusted operating margin, so they're kind of nitpicking some numbers here and there, but it's not the end of the world that they're nitpicking numbers because it's at 44 freaking percent. You pop one over here to the right. I mean, you can still see GAAP net income is still at 214 million versus 391 for adjusted. So that's somewhere in the 20s of percent. So that's pretty monstrous. I mean, that's really, really good. And then overall U.S. revenue growth of 55%, counting government and commercial. So you see the U.S. business is kind of going to be what's going to push them forward here. And then if you get acceleration on the international front, good Lord, hang on. So after reading all that, it's a no-brainer. Palantir is a monster business that if anybody sits there and tries to debate that, quite honestly, you're just stupid. It's one of the best businesses on paper I've seen in a very long time. It is right up there with the best of the best, including Microsoft, Nvidia, any of those guys. But they have one overarching problem, which is their valuation: 110 times price of sales and over 300 times forward earnings. So, as we always do in every video, we're going over our models and we're going to see what, based upon the numbers, what this could actually be worth in the future. So here's my base case. I mean, so even though we're getting really quick revenue growth numbers, like we had 55% US growth and we had 40% overall revenue growth, I'm going to go out here for my base case for 2025. We're going to go 38% revenue growth and 35, 35, 32, 30, 30, 30. Over the last 20 years, their average revenue growth has been about 30%. So it's really hard for me to say that, once they're getting to 10, 12, 16 billion, that they're going to keep growing at 50%. Just really unlikely. So here we're going to make some assumptions. We're going to assume 40% net income margin, which it's really high, but I mean, their margins have been expanding like nobody's business. So that's fair. And then 70 forward PE, they're going to be still high growing at 30% revenue growth. You'd assume earning somewhere around 30 to 40% growth at that point. And then shares outstanding not changing that much, which would give 585 billion market cap. And then really similar price of sales at 28. I mean, price of sales versus price of earnings are pretty similar. And then that'll give us a target price of $62 today and $238 in the future. So that's really bad. Like that's 60% downside from where we're at now, because it's just so steep. I mean, you're gonna have to assume some crazy things to justify this price. But we're gonna move on to the next one. We're gonna move to our bear case, and this doesn't look great, honestly. So for the bear case, I'm still gonna assume they're gonna do 35% this year. I mean, their guidance is huge. They're guiding for January 4 billion this year, and they're definitely gonna hit it. So I'm gonna assume 35, 30, 30, 30, 28, 26, 24. So kind of assuming they're gonna have a problem as they scale. It's gonna be hard to retain / grow faster, because it's just more onboarding, more customers, and there's only going to be so many large scale customers that they can get. So they're going to have to start going to smaller customers, and that's kind of where the other companies in the enterprise AI space are kind of excelling. The other companies are really good at small scale. Palantir is the only one that really dominates the enterprise, like Fortune 500 scale. They're by far the best. But, for smaller companies, somebody like an OpenAI or somebody like a ServiceNow or anything like that, they're going to have an advantage, because Palantir's advantage is they've been in the enterprise AI game so long that they're the only ones that can really hand these like billion and trillion data point sets. But these other companies, it's a lot easier to come up with something that works with 500,000 data points or a million data points versus a billion or a trillion. So that's going to be kind of their thing that they're going to have to figure out going forward is how to downsize their software where the other people are trying to upsize their software. So they're obviously going to do really well when they are competing in the large space, but there's only so much money there. So in my bear case, I'm kind of assuming they're going to have a hard time getting down to the smaller customers, and people are going to come and compete for the bigger customers, and it's going to kind of hurt their revenue growth a little bit. But even so, we're going to assume 35% net income margin, 50 PE, price of sales of 20, and then shares outstanding about 2.4 billion. Obviously, we always do discount rate of 25% because S&P 500 is about 10% overall return. So your discount rate is essentially telling you what percent return you want. So you find your future price and then you discount it backwards, as you basically doing like a backwards compound annual growth rate to find out what you think it's worth today, assuming you want a 25% return. 25% return being, like I said, S&P is 10. Palantir is about twice, 2.5 times as risky as S&P based upon their beta. So you want 25% return in order to compensate you for your risk. So that's going to give us a price of 34.80. I mean, that is brutal. If this case goes through here, Palantir is going to be worth the exact same amount, actually about 15 to 20% less in 5 years than it is right now. So that's kind of the risk for the shares right now. If something like this happens, this is a great outcome for any company. But when you're at this price, you have no room for error. You need huge growth year on year on year on year to really get any gains as a shareholder. So now we have our bull case. I mean, this is kind of what we need to do to justify where we're at. And quite honestly, this doesn't even really do it, compensating for your risk and everything. But so we're going to go 43% net income margin, 35 price of sales. For revenue growth, we're looking at 40, 40, 40, 40, 40, 38, 38. So we're assuming we can hold 40 for 5 years, basically, which is that's no short order. I mean, when you're talking growing 40% when you're doing $15 billion a year, that's nothing to scoff at. That's big numbers. So we're going 80 PE multiple. I mean, 80 is still huge, but if you're going 40% revenue and pretty much 50% net income growth, 80 is not that crazy at all. And then 35 price of sales. I mean, that's just kind of based upon their margins and blah blah blah. But that gives us $1 trillion in 5 years. And I mean, let's be real here. This valuation assumes we're still in a bull market. You go to bear market, this goes completely out of the window. They're not going to be trading 80. There's almost no way. But so then that'll give us a discount rate. That'll give us a target price of about 431 for 2030 and 113 for now. So even then, that's staying 30% overvalued, assuming they do 40% growth and 43% net income margin with a steep valuation in the future. I mean, it's not looking good. I mean, at $150 right now, this makes me nervous. This makes me really nervous because I'm giving the benefit of the doubt everywhere I can right here. And yeah, I'm basically assuming that the AI growth they have now continues, their commercial growth continues, their US government growth continues, and yeah, continues and continues in order to 5 to 7x their revenue. So it doesn't make me very confident, but we're gonna go. We have one more case, as you see here on the right, Super Bowl. We're gonna see what is the most bull thing I can come up with, the super duper bull case. Okay, so in 2030, $42 billion of revenue because we're doing 45, 45, 50, 50, 50, 45, 45. Massive numbers here, massive numbers. And we're going to assume 45% net income margin, 90 times earnings, 38 times sales, and we're going to buy back 10% of the float, which is insane. It's probably not going to happen, but it's what the super duper bull case. Okay. We're going to assume just the US commercial just doesn't slow down 50%, 50%, 50%, 60%. Just huge growth year over year over year over year over year. I mean, this is kind of like when I bought Palantir years ago, this is kind of what I had hoped would happen. Quite honestly, it hasn't happened. They had the growth slow down in 2022 and 2023, and really not until 2024 things didn't start to show. Like it really didn't brighten up till about 2024. Their commercial business the whole time's kind of been cooking. They had a really bad government slowdown in 2022 and 23. But yeah, this is what, quote unquote could happen. Everything goes right. The stars align. They can downsize their product offering to cover all size enterprises. They're the number one. They're dominating. This is what could happen. But even then, guys, 191 price target today. The problem is that if you're gonna try to compensate yourself for the risk by actually chasing a high return, if you put it at 10%, yeah, sure, it's worth a lot today. But then again, you're taking on three times the risk to get index returns. Like it doesn't make sense. You need to get that extra return in order to compensate yourself for the risk. And doing so, even in this insane case, like this is an insane thing to assume. Like, sure, it could happen. Like it's totally on the table, but to assume that this would happen is nuts. Like it's only a crazy person would say this is gonna happen. So I mean, yeah, sure, we're at $730 and 191, which is really good, but that's not gonna happen. Like realistically, I'd say the bull case is honestly pretty likely, but then even that takes into account a pretty steep valuation. Like in terms of revenue growth, the bull case is pretty likely. Like I'd go somewhere between the base case and the bull case, 35%. I mean, it's really hard to do more than that over time. So any more than $100 a share is like, I mean, dude, that's steep. Like that's really steep. So I don't know how they're gonna do that or how you can justify $150 a share. Like you can right here. That's how you do it. You need 45 to 50% growth every year. And quite honestly, anything above 40 is probably just not gonna happen. So that brings me to my point. What am I going to do with my shares? I bought my Palantir at $11.40 in 2021 and 2022. So yeah, I mean, $1 trillion valuation is not that far away. So it's 5 to 10 years from now. Realistically, it's probably going to happen. But there's no room for error. And despite their success, you know, you need to see margins. Yeah, like I said, huge revenue growth and huge margins, but it's steep ask. You can't really expect that. So for my Palantir holdings, like I mentioned, I bought at 1140 in 2021 and 2022. I just sold last week. I sold 1/3 of what I have, and then I sold call options against my 80% of my remaining position, roughly. So I mean, the thing is, I picked a December 180 strike because I'm like, okay, if it goes to $180, that takes away. I mean, that's my fair value for my Super Bowl case. There's almost no upside left. Like, I don't really care to own it past $180, and the call premiums are huge right now. So, yeah, realistically, $100 is like a good price. Like at $100, I'm perfectly cool with owning it. Anything above $150, I don't really want to own it. But like I said, the $1 trillion valuation is almost a lock for the future. I don't want to say it is a lock, it's almost a lock. Something would have to change for that not to happen in 10 years. But yeah, it's so steep right now, guys. Like taking account, like I said, headwinds, competition, $100 is like a realistic fair value for this, and I don't really care to own it with such a big percentage of my portfolio because, like I said, about $11, like I put half my money in at $11. It's a huge percentage of my portfolio, and I can't really justify holding so much of it at this point. So yeah, I'm definitely trimming, and like I said, selling call options against the rest. I will have some if I get exercise on this, I will still have some left. But yeah, it's definitely time to jump ship on Palantir for me. So with that said, guys, I appreciate you for watching the video. I you know, appreciate everybody watching. If you got any like critiques for my video or little things you might have noticed, like typos or something, please let me know just so I get a little better about it in the future. If you got like any cool concepts or stock ideas you want me to look at, or like some any macro news you want me to check out, please leave it down in the comments. Yeah, just like and subscribe. It really helps me out. I'm trying to grow the channel, so one day I want to have a launch some courses just completely free, just so I can show you guys what I know, how I learned it, and all that stuff. So, yeah, thanks so much for watching, and I'll see you next episode of Systematic Investing.